Good morning, ladies and gentlemen. I'm In Young Hwang, Regional Corporation Specialist of the Economic Research and Regional Corporation Department of ADB. And I'm so honored to be here. And welcome to the IPAF International Conference, where we will discuss the theme, Regional Cooperation for Safeguarding Macroeconomic and Financial Stability. The event will have two parts. The first, conference on macroeconomic outlook and surging NPLs amid global challenges. And second, launch of a publication on roadmap for the development of NPL online trading platform. And after the conference, a high-level executive coordinating council meeting among IPA members will be held. So we are now at the welcome remarks, and I would like to invite Joseph Ernest, the Deputy Chief Economist at the ERCD of ADB. So please big applause to him.
Thank you very much, In Young. Mr. Ho Jun Won, Executive Director, Korea Asset Management Corporation, distinguished speakers and panelists, IPAF delegates, government officials, ladies and gentlemen, good morning. I would like to welcome all of you and thank you for taking the time out of your busy schedules to join the conference. The International Public Asset Management Company Forum, or IPAF, was launched in 2013 with 7 members from public asset management companies across 5 Asian countries. It began as a platform for sharing knowledge on how best to resolve non-performing loans, or NPLs, through the eyes of different country experiences as they responded to financial crises. IPAF has since grown to include 16 member institutions from 8 countries. It has also expanded membership to deposit insurance companies. These public asset management companies and deposit insurance institutions are important pillars in building financial safety nets. I would particularly like to welcome those from Mongolia joining today's conference. Later today at the IPAF Executive Level Coordinating Committee meeting, we will officially announce that the Mongolia Asset Management Company will become IPAF's newest member. So thank you for joining us, and we're looking forward to seeing your insights from Mongolia and hope that that you find your membership in IPAF to be very fruitful for yourself as well. ADB has assisted IPAF since its inception, as its members actively share their policy experience in dealing with non-performing bank loans and distressed assets. This knowledge sharing work has led to international conferences, workshops, and seminars, as well as research studies and publications. It has helped strengthen the capacity for crisis response, helped build more effective financial infrastructure, and contributed to Asia's macroeconomic and financial stability. This conference is extremely timely. Our latest Asian Development Outlook update issued in September paints a solemn recovery outlook for the region. Developing Asia is now projected to grow more slowly than our original April forecast. We now see the region's economy growing by 4.3% this year and only 4.9% next year. This is down from our April forecast of 5.2% growth this year and 5.3% next year. Inflation forecasts were also revised up from 3.7% to 4.5% for this year, and from 3.1% to 4.0% for 2023. And this is due to higher energy and food prices. The downside risks remain dominant. These include further rises in US interest rates, the stronger dollar, and their spillover effects, slowing growth in developing economies, and an escalation of Russia's invasion of Ukraine. With tighter global financial conditions and the pandemic-induced debts pose significant risk to the region's financial systems. Heightened global uncertainties, whether in combination or individually, could lead to sharp increases in NPLs. And this could destabilize the region's financial systems and compromise an overall post-pandemic economic recovery. The impact would vary widely by country, depending on the size and type of shock. But in general, a slower than expected recovery combined with phasing out of regulatory forbearance could add to the considerable risk of rising NPLs in the years to come. Previous crises clearly underscored the negative financial effects NPLs can have on the real economy. Finding ways to swiftly resolve these non-performing assets is crucial, and something we will discuss more in detail this afternoon. As Asia's financial markets are increasingly open and interconnected, they become increasingly vulnerable to external shocks. Since the Asian financial crisis a quarter of a century ago, we have learned that approaching these challenges from a regional perspective helps build financial resilience and stability. There are several reasons for this. First, knowledge sharing, capacity development, and harmonizing policy and regulatory frameworks can help the region develop efficient NPL markets to better deal with growing NPLs. Second, greater collaboration and a multi-agency approach can also create a regional network of peers to share their insights, experiences, and search for workable solutions. Last but not least, multi-stakeholder and multi-sector collaboration can help build the regional capacity needed to design effective recovery strategies for NPL assets. ADB hopes to continue its important coordinating role in this important initiative to make these benefits come through. For example, this conference brings together government officials from ADB's developing members, representatives from international organizations, research institutes, the business community, ADB staff, and IPAF members to discuss and act upon the financial challenges associated with increased debt levels. The conference offers a venue to examine the region's macroeconomic risks and find ways to deal with them effectively. This afternoon, we will discuss how to establish an effective NPL trading platform as an additional resolution tool as we launch ADB's recent report, Roadmap for Developing an Online Platform to Trade Non-Performing Loans in Asia and the Pacific. Ladies and gentlemen, is it important that we take stock of the lessons learned to strengthen financial cooperation and resilience, which will be the cornerstone of a strong and resilient economic recovery. We need to work together to strengthen the policy framework for macroeconomic stabilization and the effective NPL market as a key element for banking and financial stability. And we can't overemphasize the role played by enhancing regulatory cooperation to achieve these and ensure greater financial stability. In closing, let me once again welcome all IPAF members and congratulate you for keeping the spirit of regional cooperation alive and thriving. I wish you fruitful discussions during the conference, and I hope you enjoy your stay here in Manila. Thank you very much.
Joseph, thank you again for your inspiring remarks. For the next to deliver the opening remark, may we call on the Mr. Ho Jun-won, the Executive Director of Korea Asset Management Corporation.
Thank you, Ms. Hwang. Good morning. Distinguished participants, my name is Ho Jun-won, Executive Director of Korea Asset Management Corporation. I would like to sincerely congratulate you on the opening of the IPAF International Conference in Manila, where the ADB headquarters is located. 3 years after the IPAF Summit meeting and international conference were held face-to-face in Seoul, Korea in 2019. I would like to extend my special thanks to Director General Albert Francis Park and Mr. Jeopardize Jr. Joseph Ernest of the ADB for inviting me to this meaningful event. I would also like to thank ADB officials for preparing for this event. In addition, I would like to express my gratitude to distinguished guests, including the Stein Classens of the BIS for being here with us today. The IPAF has grown into a truly international organization. serving as one of the pillars of financial system stability in Asia. The number of member countries grew from 5 countries in the beginning to 7, and since 2021, the number of institutions represented has increased to 15. From this year, the number of member institutions will be 16 from 8 countries, as MEMCO, the Mongolian Asset Management Corporation, will join the IPAF this year. In 10 years, the IPAF has positioned itself as an international platform where countries can share their success stories and explore investment opportunities through a number of international seminars, trainings, and joint research. In 2020, the ADP sponsors feasibility study that IPAF members participated in. It was conducted to establish the Asian online NPL transaction platform to preemptively consider direction of the Asian market and develop solution. I would like to thank the ADB's generous support to make it possible to achieve such outcomes. Distinguished guests, we would be remiss to be satisfied with become complacent about the past achievement. With the prolonged COVID-19 pandemic over the past few years, we have encountered unexpected crises such as US-China trade war and the Russian-Ukraine war. In addition, the rapid rate increases by the US Federal Reserve has increased volatility in the financial market, serving as a compounding factor in the global economy. The overlapping of such unexpected external shocks have a significant ripple effect on global financial system, including in Asia. In particular, the possibility of transitional crisis is high in Asia due to the regional high dependency on overseas market and the vulnerable financial safety net. In the face of these challenges, the IPAF and relevant organizations need to consider the path needed to deal with crisis wisely and stabilize the regional financial market. First, close communication and cooperation should always be the basis for all projects promoted by the IPAF. The IPAF has strengthened solidarity and shared knowledge and know-how through active communication among member institutions by holding approximately 20 summits, international seminars, and council meetings. The basis of such cooperation has established the foundation for joint responses to series of global challenges. Now, it is the time to make more multifaceted effort to establish the financial safety net in Asia. We are close cooperation based on this foundation. In addition, Asian countries have an interdependent economic structure. Therefore, when Asian countries mutually diagnose crises, gather opinions, and respond to external shocks in the united manner based on communication, effectiveness can be maximized compared to the independent effort of individual countries. We need to consider how to respond to changes. The international environment is changing at a faster rate than before, and the IPAF has expanded and matured through various exchanges since its foundation in 2013. Therefore, we need to take one step further in line with internal and external changes of achieving the IPAF mission of achieving Asia's common prosperity and development, as well as the establishment of a financial safety network. We need to improve efficiency and transparency in the non-performing loan market by making effort to standardize the legal and institutional infrastructure, in addition to our past effort for knowledge sharing, consulting among member institutions. Based on this, if we can form the common non-performing asset transaction market in Asia, we can respond to external shocks efficiently in the future. Moreover, it will be an opportunity to strengthen competitiveness of Asian financial system in the world. In this regard, the active online transactions among countries in Europe have significant implications for us. In order for us to respond to crisis flexibly and effectively, it is essential to develop the market where non-performing assets are rapidly resolved. The larger the market size, the faster the speed of resolving non-performing assets, maximizing efficiency. Currently, many Asian countries do not have a private market established system for resolving non-performing assets. Therefore, IPAF member institutions need to actively exchange with the private sector and identify and meet the needs of the private sector in order to nurture and promote the non-performing asset transaction market. In addition to legal and institutional infrastructure standardization effort, the IPAF is critical in achieving the two goals of policy change and market establishment by acting as an intermediary between government and the private sector. Therefore, I'd like to ask you to pay continuous attention to the voices of the market and expertise of the private sector with a great sense of responsibility. However, our role should not be limited to vitalizing the non-performing asset transaction market. We should play the role of the guide in the market to ensure that the public sector does not clear non-performing assets just for liquidation purpose, but to provide competitive individuals and companies the chance to be back on their feet. In Korea, PEMCO leads effort to vitalize corporate restructuring in the private market. Such examples include corporate rehabilitation support program and corporate support fund. In the early stage, when the market is dormant and private sector does not enter due to uncertainty, PEMCO plays a role as an anchor to support the inflow of private funds into the market. It is expected that it will create a virtuous circle across the entire economy, promote efficiency and competitiveness in industry, and revitalize the economy. I'd like to mention that the IPAF is reliable support for you. When you want to play an active role as a public institution, are unsure of how to do so, or when you face the difficulties in persuading the government or need help, the IPAF will listen to the demand of member institutions and make an effort to mutually develop solutions. Depending on what role we give to the IPAF and what activities are overseen by the IPAF, the organization can become one of our close allies. This face-to-face meeting among member institutions at the time when we are about to mark the 10th anniversary of the IPAF Foundation is a very important opportunity to dwell on our past achievement and consider future courses of action. PEMCO will also make effort to consider ways for joint development and fulfill its role together with IPAF member institutions as one of the IPAF founding members and member institutions. For IPAF member institutions and distinguished guests, the world is undergoing three major difficulties of high inflation, high interest rates, and a strong dollar, which are widening the gap between the rich and the poor. Many crises which cannot be overcome by the effort of individuals or countries alone, simultaneously emerging. I believe that the role of the IPAF and member countries is essential and becoming more important. We need to establish effective method of resolving NPLs, which are hidden behind the quantitative easing and moratorium conducted in relation to COVID-19. In a time of increasing confusion, we can establish the financial safety network of Asia with united and joint effort. I hope that this conference and council meeting can serve as an opportunity for the IPAF to mature and take a future step forward. I wish all the participants good health and safe return home. Thank you. 감사합니다.
Thank you. Thank you for your thought-provoking remarks. Okay, now I will present the IPAF progress report. And before I start, let's watch the short introduction video first.
IPAF is an international organization jointly established in 2013 by public asset management companies with the support of the Asian Development Bank to strengthen the economic safety nets of Asian countries through regional cooperation. IPAF has continuously strengthened its mission through capacity building and knowledge sharing of experience and successful management and resolution of non-performing loans among member institutions. IPAF, through its efforts, evolved from 7 institutions in 5 Asian countries to 16 members in 8 countries: Republic of Korea, People's Republic of China, Thailand, Vietnam, Kazakhstan, Malaysia, Indonesia, and Mongolia. And it has become an exclusive body of Asia's financial safety net through membership expansion from public AMCs to deposit insurance companies. Since its establishment and continuing collaboration with ADB, IPAF has conducted various range of activities for the development of the NPL market and enhancement of financial stability. IPAF has successfully held a total of 6 summit meetings and international conferences, conducted 7 training seminars, and 8 working level meetings to enhance its capabilities and promote cooperation in Asia over the last 9 years. Moreover, it has expanded knowledge sharing not only among IPAF members, but also with ADB developing member countries by hosting 7 international workshops and seminars led by ADB. ADB has also published several research papers and publications based on in-depth research and feasibility studies on NPL markets. As an achievement, its members have enhanced their operational capabilities from establishing new legal framework to increasing fund size. In addition, IPAF has strengthened its regional cooperation through productive policy dialogue with Kazakhstan, Mongolia, and Bangladesh. During the wake of the COVID-19 pandemic, all activities have been actively moved online, allowing more countries and institutions to participate. Moreover, in order to address the rapidly increasing NPL and to facilitate NPL transaction in the post-COVID-19 era, IPAF is getting ready to adapt with the surge in digital transformation by establishing an online NPL trading platform. Ahead of its 10th anniversary next year, IPAF is now at a crucial stage to take a leap to the next level as a major regional platform in Asia. IPAF will continue to expand its membership to more countries in partnership with other relevant international institutions. IPAF will further facilitate NPL transaction by establishing investor-friendly environment. IPAF aims to improve and stabilize the Asian national economy through the development of NPL markets and the establishment of a financial safety net. .
please show the PPT? Okay, because I think perhaps some of you here are aware of the IPAF. Of course, there's a IPAF member institutions come here. They well known about it. But because there's someone who don't know about it, so I will gonna explain about the establishment and our kind of the activities and achievement and our future direction. Before the presentation show on the screen, I will gonna explain about that how we establish the IPAF. Actually, first in 2012, at the International Hanoi Conference, this committee was proposed and conceptualized to collectively address regional economic issues. And in 2013, the International Public Asset Management Companies Forum, IPAF, was founded by 7 public asset management companies from 5 developing member countries. Actually, its vision is to reinforce of the economic safety net by promoting cooperation and sharing knowledge in addressing financial vulnerability. IPAF members are quite committed to providing knowledge and training. That's a kind of the regular activity. Through mutual cooperation among members, IPAF shares strengthened crisis response mechanism. And in this process, actually, a group of our ADB developing members requested ADB to support the establishment of IPAF and activities of IPAF. So in response, the technical assistance 8370 establishment of the IPAF was approved on May 2013 with the main components of object. And the first one is to assist in the establishment of IPAF. Second, to generate knowledge on crisis resolution and asset management. And third is to build capacity building in public AMCs and institutions. And this first TA was successfully achieved its expected outcomes until its completion by 2017. And after that, because there's also a lot of IPAF members and they wanted to actively cooperate it, so the second TA was approved in 2018, and it's extended to the end of the next year with the broader goals and objectives as usual. So we were gonna do the identify strategies for NPL resolution mechanisms and development of NPL markets, especially in Asian region. And we'd like to conduct research and training seminars tailored for Asian developing economies and continue working with IPAF, especially in research NPL. And also collaborate with the European Central Bank, because in Europe, they have a lot of really developed NPL markets nowadays. So we did a lot of collaborate work with these. And next, let's take a look at the IPAF's regular activities and achievements so far, because there's newly joined members. So even IPAF members does not know what kind of activities we were gonna done so far. So I will gonna briefly explain about it. So when IPAF was launched in 2013, as we mentioned before, 7 members from public asset management AMCs from 5 countries, Republic of Korea, People's Republic of China, Thailand, Vietnam, and Kazakhstan joined as a founding member. And as of now, we evolved to 16 members in 8 countries, including Malaysia, Indonesia, and newly Mongolia. And as we expanded its membership to the deposit insurance companies, we have 11 general members and 5 associate members, as you see here. So we particularly welcome and congratulate that the Mongolia Asset Management Company has become IPAF's 16th member. Based on IPAF charter, we have regular activities such as IPAF summit meeting and international conferences, coordinating council meeting, and training seminars and research. First, the IPAF annual meetings and conferences. This is the biggest event among the IPAF activities. General members take turns service as a chair member every year, and they organized the annual summit meeting and international conference. It has provided a venue for addressing global economic and financial policies and issues. The summit meetings was also conducted among the members to define strategy and develop concrete action plans for IPAF. So since its establishment, we have had 6 IPAF summit meeting and international conferences successfully held, of course, in collaboration with ADB. And also we have knowledge and training events, and we have 7 IPAF training seminars successfully held. And this is about to elaborate our knowledge and experiences, especially with the IPAF member staffs and developing countries. So IPAF has conducted this program aimed at sharing knowledge and experience to enhance the distress asset management capability. So normally when we have this kind of the training seminar, we have over 70 participants from all over Asian countries. And after COVID-19 pandemic, we switched to the online training seminar and took an opportunity to attract more attendees. For example, when you look at the picture, the left picture, so when we have a virtual seminar last June, it equipped more than 150 participants from 12 developing member countries and 22 financial institutions, including central bank or Ministry of Finance and asset management companies. And also we have a coordinating council meeting and to discuss of the important matters with the person who in charge of IPAF. And ADB has successfully held 7 separate international workshops and events. ADB has strengthened knowledge dissemination by inviting government officials from our developing member countries and has been sharing knowledge and experience in cooperation with the European Central Bank and EBRD. In particular, during the COVID period, practical alliance seminar on NPL resolution techniques and valuation and legal systems were held for spurring knowledge sharing activities. And also, as you see here, ADB also has conducted a variety of the research and provided knowledge and products to IPAF members and other DMCs. So ADB has produced publication and major research papers and case studies on the successes and failures of the public AMCs in the region. So you can download all this kind of papers and publications from ADB website. And the policy dialogue, ADB and IPAF also has conducted policy dialogues with policymakers on the financial vulnerability issues, in particularly distressed asset and non-performing loans and practices of the AMC in the region. Over the past few years, a lot of efforts has been put into making a policy recommendation to ADB DMCs, such as Kazakhstan, Mongolia, and Bangladesh, and it is actually bearing some fruits. ADB has met with high-level officials from Central Bank, MOF, and relevant government body to do the fact-finding and provide a policy dialogue. Also, ADB and IPAF have supported these countries through the technical assistance and consulting services, and also capacity building events. And future direction. As you watch the introduction video, this year's 9th year since it is established, and next year is the 10th anniversary of IPAF. So we already agree with that IPAF is now at a really crucial stage to leap forward to a next level. So IPAF will continue to expand its membership to more countries and to more institutions, not just only between the public AMCs and deposit insurance companies. And also, we were going to improve our partnership and commitment with our relevant international institutions. IPAF will further facilitate the NPL transaction by establishing investor-friendly environment So as a part of that, we already completed the first feasibility study on the establishing an MPL online trading platform. And this afternoon, as a second session of the conference, we will have the launch seminar of this book as a result of it. And we also plan to have a second feasibility study next year on operational guideline towards establishing an MPL trading platform in the Asia. Also, we established a research committee under the IPAF in order to support IPAF research and strategic direction. We hope that information asymmetry can be resolved and more meaningful data can be drawn through this committee. As you know that the IPAF aims to improve and stabilize the Asian national economy, especially through the development of MPL markets and establishment of the safety net. So we do ask you for your continued interest and support for the IPAF. And thank you.
In the other parts of Asia, in East Asia and Central Asia, the inflation pickup has also been very strong. And what a turnaround since 2016, when global, at least outside recessions, global inflation was very low and everyone was worried about deflation. Now, this has triggered an extremely strong monetary policy tightening. You've all read about the US Fed tightening, but it goes beyond the Fed. And that's what the chart on the left shows you. All the major central banks are tightening, are raising their policy rates, are tightening monetary policy. So here the chart on the left has the G7 policy rates. The red line is the current US Fed tightening cycle. The dashed and dotted lines are the 1970s US Fed tightening cycles. You see a bit of zigzag there because the policy instrument changed at the time. It wasn't all about interest rates. But you can see that the 2022 global policy rate increase was on par with that in the 1970s. It's really in a different league from the ones that have happened ever since. It's an extremely rapid and steep policy tightening globally around the world. And as it happens, it coincided with fiscal tightening as well. In the chart on the right, you see the fiscal impulse. So the change in the fiscal structural balance. So, and positive is a consolidation and a negative is a, thank you. A negative is a stimulus. You can see the 2020 stimulus, but you can also see the 2022 consolidation. You can see that in the G7 countries, fiscal policy has never tightened that much for as far back as the data goes, which is 1980s. So we're in the midst of an extremely steep policy tightening, both on the fiscal side and on the monetary side, and all the major economies. That's 55%, sorry, that's 40% of global GDP here, the G7 countries. And even with that, yes, global inflation will come down. So we model what our growth forecasts and what our energy price forecasts mean for global inflation with the Oxford Economics model here. And you can see on the chart on the left what it means. Global inflation, so median global inflation will come down from almost 9% to 3.5% by the end of next year. And that's entirely, almost entirely because of the energy price decline as global growth slows. But bear in mind, compare that to the light blue bars. This will still be inflation about 1.5 percentage points above the 2015 to 19 average. So in all likelihood, even by the end of next year, inflation will still be above target. And it's not just our model, it's also the consensus forecast for inflation. Yes, they come down, but they come down even less actually than our model forecast. So probably by the end of next year, the inflation problem will not have been solved, and central banks will continue to face high inflation and low growth. So what does that probably mean? But there's a high likelihood that we will have stronger monetary policy tightening. And this is what we explored in a scenario analysis. Two scenarios in particular we look at. If inflation is that high for that long, that much above target, there's a risk that inflation expectations in the medium term come adrift. And then central bank policies will have to tighten. They will have to tighten sufficiently to bring inflation down. So we are assuming now two scenarios that monetary policy rates globally go up by either 100 basis points or 200 basis points. If they go up by 200 basis points, that's accompanied by financial stress. So those are the two scenarios we look at here. The global slowdown, the sharp downturn scenario is the one with a 100 basis point increase, and the recession scenario is the one with a 200 basis points policy rate increase plus financial stress. And you can see what that does to growth. So the blue bars on the left chart, they're baseline forecasts from consensus forecasts. Growth will go down. And it'll go down even further if we have a stronger policy tightening by another 100 basis points. If we have a 200 basis points additional monetary policy tightening in 2023, plus financial market stress, we could easily find ourselves in the red bars here, which is a global recession. A global recession is defined as negative per capita income growth. So population growth globally is around a percentage point, which means that red bar in per capita terms is actually a negative, a contraction in per capita income. Yeah, so it is a global recession. So a very difficult year ahead. But look at the chart on the right. Even a global recession doesn't solve the inflation problem. You can see that in the chart on the right, global inflation will come down a little bit next year by a 0.5 percentage point in the slowdown scenario, and by a bit more to almost 3% in the recession scenario. But that's entirely because of the oil price decline that comes with a global recession. Global core inflation will still be running, at least by our model forecast, at 5%. That's almost 3 percentage points more than the 2015 to 19 average. So the inflation problem will not have been solved even when there's a global recession. It takes until 2024 to bring global core inflation down to about 3 percentage points. That's still above the pre-pandemic average, but it's closer. And what will happen in headline inflation is that energy prices will rebound and global headline inflation will actually pick up, even if, in the global recession scenario, the red bars you see on the right. So in all likelihood, next year we will still face another year of weak growth, high inflation. That's one of the definitions of stagflation. And the world has been there before. It's been there in the 1970s. So in the 1970s also, that was then met, this kind of combination of weak growth and high inflation was met with an extremely strong monetary policy tightening. You remember those dotted and dashed lines in the policy rate chart. Now that did end stagflation in advanced economies, but it also caused the global recession in 1982. You can see here in the chart on the left what happened to per capita income growth in the years of global recessions. In the 1982, per capita income fell by 1 percentage point. Yeah. And actually you see in the chart in the center, 50% of countries in the world saw an outright output contraction. So GDP as a whole contracting. But it brought an end to stagflation, at least in advanced economies. Now, what advanced economies remember as the end of stagflation is something that emerging markets remember as the beginning of a series of debt crises. And you see that in the chart on the right. It was sovereign debt crisis in particular. The orange bars, the 1980s were the decade with the largest number of sovereign debt crises since the 1970s. So what does that mean for emerging markets and developing economies? Well, remember, the outlook is for lower growth and tighter borrowing costs, higher borrowing costs, tighter financial conditions. That is the classic trigger of financial crisis. We looked at 43 case studies of financial crisis. The majority, vast majority, almost all of them were triggered by an external shock that are then combined with domestic vulnerabilities. And the most common external shocks were a growth slowdown and rising US Fed interest rates. So we have all the ingredients for financial crisis. And the domestic vulnerability that is the most pronounced, and that also comes out in regression analysis as the most important one in driving the probability of crisis, is debt, a rapid run-up in debt. And you can see here in the chart on the left what happened to debt in emerging markets and developing economies. It is now at record highs. Government debt is almost back to the levels of in 1987, when we had all these Latin American debt crises. Private debt is at record highs. And it's not just in a few countries. You can see in the center chart, it's very broad-based. In every region, debt has risen, and in just about every region, it's at multi-decade highs. So debt is high, and that's a real vulnerability. So the debt run-up since 2010 has actually been dubbed the fourth wave of global debt. Since 1970, there have been 4 waves of global debt. So in the 1970s and 80s, there was the syndicated loan market that discovered Latin America and Sub-Saharan Africa, and you saw this big run-up in debt. And that then ended with, well, the Brady bonds and HIPC for Africa. Then in the 1990s, the corporate, not just corporate, actually bond markets in general started to really develop in East Asia and Europe. And that ended with the Asian financial crisis and the contagion it caused to Europe. And then the 2000s, the mega banks expanded. European mega banks expanded all over the world. And that was, of course, cut short by the global financial crisis. This time around, this debt buildup since 2010 has been the fastest and the most broad-based of any of the global waves of debt. The chart on the left here shows you the pace at which debt has grown per year. So per year in emerging markets and developing economies, total debt has grown by more than 7 percentage points of GDP. Now, a lot of that, fair enough, is because of China. But even if you exclude China, debt has grown by about 3 percentage points per GDP every single year on average since 2010. This is one of the largest debt buildups that we have seen in half a century. These types of debt buildups often end in crisis. We have looked at more than 500 episodes of rapid debt accumulation in 176 countries. And we have found that of these more than 500 episodes, more than half, well, about almost half, ended with kind of financial crisis. The ones that were particularly pernicious and crisis prone were the government debt buildups. So the median government debt buildup through one of these episodes was about 30 percentage points of GDP. As it happens, the debt buildup in government debt since 2010 and EMDEs on average has been 33 percentage points of GDP. At this point, almost half of emerging markets and developing economies fit that definition of a rapid debt accumulation. In the past, about half of the rapid government debt accumulation episodes were associated with financial crises. That's the concern now. Private debt, not so much, because private debt, there's a larger component of financial deepening. It's really government debt buildups that are often associated with crises. So the government debt levels and debt levels in general are a concern, but it's not just the debt levels, it's also the composition. If you just go back here to the chart on the right, it shows you the share, the average EMDEs, share of foreign currency denominated government debt and variable rate external debt. The whiskers, the yellow whiskers, those are for Asia. So it's not like Asia is a big outlier. Asia has its own outliers in there. And you can see that about half of government debt is foreign currency denominated, and about a quarter of EMDE external debt is at variable rates. So the appreciation that's currently happening, the dollar appreciation, and the borrowing cost increases, they're passing right through to these countries' debt service. So what can we expect from policymakers? And there's not much we can expect on the macroeconomic policy side. Really, on the macroeconomic policy side, fiscal policy, monetary policy, financial policy, it's about brace for impact. Monetary policy has to bring inflation down without causing financial crisis, financial stress. Fiscal policy has to restore fiscal sustainability while still supporting the most vulnerable households. And financial policy has to preserve financial stability without undermining the inflation goal. You know, the UK has, in the last couple of weeks, there's been a bit of an example of the trade-offs in that are difficult. So we can expect very little support from the classic macroeconomic policies if we do actually slip into a year of global recession. So the only thing left that we can only hope that policymakers will do is structural reforms to boost growth. The good thing about these is not just for the long term they boost growth, but they also boost confidence in the short term. Some of our analysis shows that actually consensus forecasters reward these reforms. A persistent period of improvements in these structural indicators of business climates and governments are actually rewarded with better confidence forecasts for long-term growth. So this is a win-win, but of course, these are incredibly difficult to implement. They're highly country specific. There is really no broad-based recommendation. Every country knows probably very well what needs to be done to boost growth. No many reports have been written. They're just incredibly difficult to implement. So to sum up, the short-term outlook is actually gloomy, as the title of this session is. In the baseline scenario, we just have a steeper slowdown, then a further slowdown from 2022, but there is a very real risk that we slip into a global recession. For EMDEs, emerging markets and developing economies, this combination of slowing global growth and rising global borrowing costs could well mean that we have a large number of financial crises. For now, financial stress is just focused on a few countries. It's like a bunch of little fires that can be put out. The risk is that these little fires combine into a big conflagration that brings in a much larger number of countries. And we can expect very little policy support from at least the classic macroeconomic policymakers. We can only hope that the structural policies can help boost confidence at least. And I invite you to have a look at our publications where a lot of this is detailed in all the methodologies, everything is available in much more detail. Thank you very much. I look forward to the discussion.
Before we started, we're gonna just introduce Mrs. Shin-Young Park first. And she's the director of the Regional Cooperation and Integration Division of ADB. And she will chair the discussion. Shin-Young has been a main author and contributor to ADB's major publications, including Asian Development Outlook and Asian Economic Integration Reports. Sorry. And she has also participated in various global and regional forums, including the G20 Development Working Group, ASEAN, ASEAN Plus3, APEC, and ASEM. She has written and lectures extensively about the Asian economy and financial markets. Prior to joining ADB, she worked at the Organization for Economic Cooperation and Development, and she received her PhD in economics from Columbia University. And Shin-Young will introduce panelists and moderate the discussion afterwards. Shin-Young, floor is yours.
Okay, well, thank you. I'm very pleased to have friendly faces and also the distinguished guest to join the panel. Well, we have Marty Hinojales, who's our long-standing friend. She's now economist in the regional surveillance team. She works mostly on issues concerning trade, supply chain, FDI in the region, as well as climate change. She is among the co-authors of MRO, the ASEAN Plus3 Macroeconomic Research Office, headquartered in Singapore. She's also contributing to its annual flagship publication, ASEAN Plus3 Regional Economic Outlook, and also the country surveillance activities, especially Vietnam and Thailand. Prior to joining MRO, she also worked as a South and Southeast Asia specialist for Verisk, a global risk consultancy firm. Before locating to Singapore, she spent a decade with the Asian Development Bank, and where she worked on macroeconomic surveillance and also the regional cooperation. She holds a bachelor's degree and master's degree in finance from the University of Philippines, the Diliman. She's currently pursuing her PhD in international political economy at the Nanyang Technology University. Now, we are also very honored to have Dr. Hash Chulun, who's currently serving as a member of Monetary Policy Council for Central Bank of Mongolia. And he's also an associate professor at the Department of Economics of the National University of Mongolia. Prior to the Central Bank of Mongolia, he worked as a chairman of National Development and Innovation Committee of Mongolia, a government agency in charge of national planning and development strategy, innovations, investment policy, which later became the Ministry of Economic Development. He also was appointed as an inaugural chairman of Board of Directors of newly organized Development Bank of Mongolia. He worked at the National University of Mongolia and was engaged in managing a number of NGO and research consulting activities. He was also a member and editor of Mongolia's long-term sustainable development strategy, ratified by Parliament in 2015. Also, the Mr. Kash Shulun held various prominent positions, both from the government and academia throughout his career. He earned his PhD in economics from Keio University. He served also as the American Eisenhower Fellowship Fellow in 2007 and holds a degree in economics and a master from Moscow State University and masters from Yokohama City Universities. So really global. Last but not the lastly, but not the least, our own Arif Ramayandi, who is a principal economist in the macroeconomic research department and division of economic research and regional cooperation department at ADB. He is mostly responsible for the working for the macroeconomic surveillance part of the Asian development outlook. And he is currently in charge of some macroeconomic modeling activities. Prior to ADB, he was the director of the Center of Economics and Development Studies at the Padjadjaran University in Indonesia. Don't laugh. I tried my best. So he has published in the field of macroeconomics and development and served as a consultant for various international organizations and government institutions. He holds a PhD in economics from the Australian National University. So we really have a good composition and excellent speakers and panels. Let me first actually turn some questions to Francisca based on the presentation. I was quite intrigued. So in your view, how likely is a global recession? And if you have any expectation for how long the US Fed will continue its interest rate hikes? Like, you know, people in the investment circle, like talk about like a 4.75, 5, will it actually reach 5%, which seemed very far-fetched even during the COVID. Now, how far you feel that the Fed interest rate hike will go, and what will be the implication for Asia?
Yeah, thank you, Sing-Yun.
Can we
So
take off the mask? I think it actually bumbles. If everyone is okay.
Yeah. Okay. Yeah, so global recession is not the baseline scenario. It's a risk scenario. We still expect in the baseline that growth will slow, but not to such an extent that per capita income growth falls. But the baseline scenario I showed in these slides, these blue bars, that's probably out of reach already. So at this point, I mean, we're still doing our forecast, but at this point, we're thinking that the global slowdown, the sharp downturn scenario, is closer to the baseline scenario. And that also means we're getting closer to the global recession scenario. How far the Fed will raise rates? So of course, our baseline assumption is always the same as the market, which is almost 5%, but not quite 5 percentage points in this cycle. You remember the slide with the policy rates, it'll go up this year, and then very early next year, it'll basically stabilize just under 5%. But it'll take a bold central bank that just ignores above target inflation by the end of next year, regardless of growth. 2 years of above target inflation probably worries every central bank, even a well-established central bank like the Fed or the ECB. So really the global recession scenario is not that far off the baseline, because it's quite possible that by the end of next year, the Fed will still look at above target inflation, and will decide it just cannot risk inflation expectations becoming de-anchored. So it's quite possible that our 200 basis point higher Fed rate hike that we have in our scenario will actually be the one that materializes, not in the baseline, but as a risk scenario that's not a tail risk.
Thank you, Francisca. You know, we recently released Asian Development Outlook. So I'm going to ask our expert, what do you think about the chances of, the economic slowdown in Asia?
Thank you. Thanks very much, Senya, and thanks, Francesca, for the presentation. I would really like to disagree with Francesca, but I cannot. Everything she said is what we observe these days anyway. So in terms of Asian outlook, developing Asia outlook, we were looking at quite a sharp slowdown in our baseline. And that's given the baseline that Francesca has in her presentation, that next year, although economic slowdown is going to be seen globally, but the global economy will still be growing in a positive way, right? So given that, Asia will also see a major slowdown. And this slowdown in Asia will mainly be driven by the weakening global demand in general, as well as slower economic activity in the PRC due to the zero COVID policy and other restructuring economy that they undergo these days. So those are the two things that will underlie the economic growth prospects for developing Asia next year and even in 2024. One thing that is going to be very important as well is about how much interest rate will be hiked globally, particularly in the US. Francesca has said something about interest rate will continue to grow in the US, and then, but she also mentioned that she also expects inflation rate to start somewhat moderating next year and next and in 2024. This is something that we also need to watch. Something that's not very clear for me from your presentation, Francesca, is what is the underlying assumption of interest rates there? When inflation starts slowing, will interest rate be continue to increase globally, or will it also coming down somewhat? If it does come down, then it's a good news for our region to some extent, because at the end of the day, we don't have to really think about tightening our monetary policy so much in order to stabilize exchange rate. But if that decline in global inflation has to come together with continuing increase in interest rate globally, then that's going to be quite a bad news for us, because at the end of the day, the region will also need to be dealing with the stabilizing their exchange rate in order to keep their financial sector intact. I think I'll stop there before we continue.
Thank you. Well, uncertainties are very high, and I think the role of MRO and macro surveillance is going to be very crucial. In addition to the rising interest rates, strong dollar is now hurting a lot of economies in the region, especially Southeast Asia. I've seen. So, what's your view about the central bank's responses to this?
Thank you, Senya, and thanks for having Amaru here in this very timely and relevant conference. Like what Francisca said in her presentation, we're seeing inflation in the ASEAN +3 exceeding already targets by central banks in the region, and in some places it's quite a wide margin, right? So one would say there's a need for further monetary tightening so that you can bring inflation back below targets, as well as anchor inflation expectations. What we're seeing in the ASEAN plus three's monetary authorities, they're basically doing two things to deal with this inflationary pressure as well as the depreciation. First, of course, the monetary tightening. Some central bankers have become quite aggressive in tightening, some more preemptive than others. This has actually quite helped stave off some of these pressures as well as prop up their currencies. But we recognize that central bankers are actually walking a very tightrope to basically balance staving off inflation, propping up the currency, and then on the other side, you also have to protect the very fragile post-pandemic recovery. The second one, of course, that they're doing is they're prudently intervening in FX markets. I guess the primary objective really is to manage the volatility of the exchange rates while allowing the currencies to basically move in line with fundamentals. In Amaru's view, this should enable, smooth functioning of the markets without it draining a lot of the FX reserves that we have built. I think the operative word really at this time is really more prudent. A prudent mix of tightening and intervention should help maintain the credibility of ASEAN plus three central banks while dealing with inflation as well as depreciation pressures.
Okay. Well, luckily, we actually have someone from the region central bank. So what's the situation in Mongolia? Like, how is the Mongolian central bank actually responding to the depreciationary pressure and then also the inflation?
Thank you very much. And I'm very thrilled to be with such distinguished panel and wonderful presentation, and also very happy to know that Mongolia is the newest member of the IPF, and it's very great chance for us to learn from other countries in this field. I would like to say that as Mongolia, we have actually kind of had this challenging situation maybe in last few years on the scale which we haven't seen before, maybe because we are a landlocked country. It creates difficulties on its own, but in addition, we have our neighbor country engaging in a war in the last year, almost without perspectives to end. And on the south, we have PRC, which is with zero COVID policy and with related logistical problems caused by that, and industrial supply chain breakdowns. So in addition to these two things, we also during the COVID pandemic, the government and the central bank implemented a number of measures to soften the blow to the average citizen in terms of creating tax breaks, maybe some household support and social protection measures. But as pandemic is finishing, these measures also are ending. So there is a challenge to come back to the normal situation. And in 2 years, people already most forgot what it means actually to pay all the utilities in full, not to receive any social kind of protection. And this is also a challenge which we are facing maybe from this January. And in addition, as a commodity economy, commodity prices are extremely volatile. It's very hard, for example, for the Ministry of Finance, maybe central bank, to predict what exactly is going to be commodity markets next year, because they're changing so quickly. And the global financial situation is also very kind of gloomy, as it was already presented in today's excellent presentation. Is tightening on the efforts, on the foreign exchange markets and all this volatility. So the Central Bank of Mongolia is trying to address this issue in a number of ways as much as possible. I would say that I very like this expression today: brace for impact, do the best what you can. Yes. So the central bank during the pandemic years lowered the interest rate in a scale probably most in East Asia, and in order to try to revive or to soften the blow to the enterprises. And last year, together with the government, the central bank also executed a program of national economic recovery, in which the central bank and the government provided some kind of subsidies to the banking sector to revive the loans. It's not money printing, but it's a little bit kind of stimulating banking activity. And from this year, the policy target is to reduce inflation. Inflation is already hitting 15%, 16%, which is something we haven't seen for 20, 30 years. Yes, and in order to keep the inflation under 10%, the central bank is undergoing a number of measures to tighten the money policy, to reduce the repo, to increase the policy rate also as much as possible. And in order also to protect the exchange rate, since we are a landlocked country, a lot of goods come from the imports and they directly hit the consumers also. So a very challenging year, of course, but we're also projecting about 2 to 5% growth. It's interesting from the, economics point of view. It is a kind of stagflation, but it also has some slow growth. It's something we haven't seen maybe. It's not just recession and inflation. It is kind of slow growth and high inflation. So our monetary policy guidelines for 2023 is being discussed now at the parliament, and hopefully it will be passed soon. So these are the main targets. Also, we have to strengthen the banking system because of rising number of NPLs. It's all over the world, I think, yes, and create more smoother functioning of the NPL market. And that's one of the reasons of the IPF, I think, participation for us, and also to learn from other countries, in particular from Korea. Kamco, I think, has wonderful experience in this field. Other countries like Kazakhstan, maybe our partners. And so in general, we also have to pay attention to raising a microcredit market, microcredit, especially related with financial applications, mobile applications, something new, but it also creates its own wave of NPLs, although it's very small kind of. So it's interesting developments in the field, and hopefully we are bracing for the impact, yes, and trying to do whatever we can. Thank you very much.
Okay, well, thank you. I think your remark kind of like nicely bring us to the discussions of debt. In fact, one of the things that really alarm us in your presentation is the accumulation of debt. What is your assessment about the regions that debt sustainability risks? What countries, if you can, are specific, like much more vulnerable than others?
It's not just about the level of debt. It's a bunch of factors that go in. So the accumulation of debt is one of the biggest. For example, if a country is in a rapid debt accumulation episode, like a 30 percentage point of GDP increase in government debt plus private debt. So if both go up at the same time, that raises the probability of a financial crisis of any sort by about 6-fold. So it's a combination of things. It's not just government debt. It's a combination of government debt plus private debt. It's a combination of a rapid debt increase with the high forex share of debt, with the high variable rate share of debt. So the more of these vulnerabilities are present when this external shock hits, the growth slowdown or the Fed interest rate hike, that's really what increases the probability of a financial crisis. The more vulnerabilities come together, the more likely a financial crisis. But yes, we also, our president Malpass is on the record as having been extremely worried about debt crisis. Our previous chief economist, Carmen Reinhardt, her whole work program was about debt crisis. And once a debt, especially government debt crisis happens, it's very difficult to resolve. Inflation is really not a solution. It's just a solution if you have a one-off increase in debt. It's not a solution if your increase in debt takes a long, is structural, like this one has been. So it's very difficult to resolve government debt. It just takes years to unwind it again?
Well, seriously, I actually always feel that in recent years that we are really facing precarious situation. The slowing growth added by rising interest rates, never a good news for indebted countries. So I wonder, how maybe the MRO now assess the generally a region's risk situation in the debt market.
I'm afraid I also cannot disagree with Francisca. In Amro's view, I think if we talk about debt sustainability, we're basically looking at two things: the sovereign debt as well as the corporate debt, right? And sovereign debt, we would think it's really the refinancing risk or rollover risk that is posing the biggest risk. One is that when you have to renew your borrowings, you're faced with higher interest rates. And two is when, if you have to issue new debt to roll over and investors are quite concerned about it, then you run the risk of failed issuances, right? And that jeopardizes your ability to pay your debt upon maturity. I think the debt distress, it's a scenario that AMRO is really looking at. But I guess if the question is considering the sharp rise in interest rates and currency depreciations, is the ASEAN +3 teetering on the edge of an Asian financial crisis or similar to it? Would like to be more on the positive side in AMRO for several reasons. If we're thinking if the ASEAN +3 is courting a financial crisis that is similar, I think it's quite unlikely. Rising interest rates in the US would probably not affect the ASEAN +3 as it did in the late 1990s. I guess for several reasons. One is, we've made a lot of painful structural reforms in the past 2 decades, to rebuild balance sheets. We've created more resilient regulatory frameworks. We've strengthened our economic fundamentals. And I guess a shout out to our region's policymakers. I think they've become more skillful really in navigating the uncertainties. We've had several layers of global financial safety net, trillions of it. We've accumulated a large number of foreign reserves as well. And they can also tap some of these multilateral currency swap arrangements like the CMIM, the Shanghai Initiative. In terms of fundamentals, some of the emerging economies that we've seen are now running current account surpluses, right? Not unlike what happened in 1997. Currencies are, fluctuating based on market forces. We have, developed also the local bond markets. So the currency mismatch that we've seen before is somewhat minimized at this point. And of course, we believe that at least the financial sector that we have in the region is now more resilient. We have the Basel regulations in place. The banks are well capitalized and there are sufficient liquidity buffers. But of course, it's not to say that there are no chinks in the armor of the ASEAN +3. There are pockets of weaknesses. We're still coming from the COVID pandemic. There are pandemic scars in the financial sector. We have NPLs that are likely to increase once you wipe out the regulatory forbearance. But in our view, we have this mitigating strategies by policymakers. And that gives us a level of some sense of comfort when that distress happens.
Thank you. Well, beyond ASEAN +3, actually, I do feel that there are greater risks to the countries, as Francisca noted in her presentation, the borrowing in a foreign currency, right? And then especially with the variable interest rates. You are also doing the macro surveillance at the bank. Have you sort of seen any kind of changes, or do you see the possibility of risk really materializing next year?
Well, what we see and what we hope cannot always go in line together. So I hope no bad thing should materialize next year. But The trend and the tendency that we're observing these days do hinted on some possibilities of that crisis might happen. So let me just go back to this. Having growing amount of debt is never a bad thing whenever, if you have good and good quality growth rates to accompany it, so that you can always service your debt, and then you're looking at your economy is going better. But the situation currently is not, unfortunately, not looking like that. We have a growing debt. We have a recovery that is unfinished in a lot of places, including in developing Asia. And we have inflation problems, exchange rate instability issues, and stuff like that. So what I would like to re-emphasize is the thing that Sin Young rightly mentioned at the beginning. Uncertainty is so high these days. And in order to deal with this kind of things, I would like to bring up something that also Sin Young knows very well. The possibility of having good communications among policymakers across the globe. That's the bare minimum. So everybody, it will be nice if everybody can communicate on what they will do in order to deal with their domestic economic problems, right? Including the advanced economies. If we can go forward, it's going to be even better. If we can move this good communications into some sort of coordination, that's going to be much, much better, especially for countries in our region in particular. And if we can bring it a level up, go to some possible cooperation, then that's going to be perfect. I'm not looking at the best. I'm just hoping that we can have at least good communications on policy going forward, so that every policymakers, including in this region, can think better about what sort of policy mix that they need to do for their country in order to deal with pressures from the outside. Stop there. Thanks.
Thank you. Now, there was a bit of concern that like that, especially the maybe deteriorating quality of debt are not fully recognized during the COVID time. As Marty already also mentioned, the many economies in the region, it kind of gave a bit of a regulatory forbearance, especially like the financial regulators in ASEAN post as some exercising very strict sort of like the monitoring of the quality of debt. And then you also mentioned in terms of risk coming from the microcredits. There are a lot of microcredit not fully like regulated, and it's hard to even monitor like how much sort of like debt are seeing the deterioration in their qualities. From Mongolia, like what do you observe like as risks, and how does Mongolian central bank actually respond to control those risks?
Okay, thank you very much. Well, yes, the debt issue, I think, was something which was not that much highlighted during the COVID times. Yes, everybody was assuming that it's okay because we have to survive, and increasing debt by some few percent, and then would be not a big deal, something like that. But now we see that the debt is becoming a major issue. I think major issue. This is the same also for our country, because we also have its own share of private debt and state debt and government debt as well. And from our side, this year the government is trying to reduce budget deficit, and in order to keep the debt growth in the check, let's say so. The central bank is trying to prioritize forex reserves rather than exchange rate. So as we say, we are bracing for the impact, right? So, and number three is that we also have to regulate better the fintech field. I'm not sure about other Asian countries, but we see a lot of, let's say, last year activity related with Bitcoins, for example, and they did also create its own number of problems, especially kind of NPLs, but they are not recognized as such, I think, but they should probably. And also the NPLs related with, as I mentioned, with microcredit applications, which are operating without collateral. And they look easy, but it also creates a number of problems for households. So these issues are all we're trying to address in the central bank activities. And also we have to, I think from our side, together with our international partners, I think partners from Korea also helped in that. A few years ago, we prepared a draft law on the NPL resolution. And I think it's maybe a good time we resubmit it to the parliament. And I think we also received some advice from ADB in this field, because this issue with NPL is going to be a major issue in coming years. And I think that with inflation, maybe hopefully as situation in PRC clarifies, we have a maybe gradual economic recovery and inflation slowdown, and then we can think about how we address the NPLs. And then we have probably cleaned for the next, foundation for the next era of growth. So that's also probably what we are doing on our side. Thank you.
Thank you. Well, I want to raise the same question to all, given that we have many executives from the asset management companies from the region here. What advice would you give? So maybe we start from Marty.
I guess from Amro's view, right? Because our stakeholders are the region's policymakers, and I guess in that sense, executives from regional AMCs would also be somewhat influenced by that. I think I'll build on what Francisca said earlier in her presentation. I think at the moment, considering that we're looking at sharper rise in interest rates and rapidly increasing inflation, we usually hear about how to roll out monetary and fiscal policy support. And at the sidelines, we also shouldn't be forgetting the fact that we need to accompany these policies with structural reforms. And when we say structural reforms, things like policies that can improve productivity, ease supply side constraints, because although they might affect the economic activity with a bit of a lag, but it would be helpful still, in fighting inflation, if you ease some of these supply side constraints. Like Francisca said, there's really no specific recommendation, really. It depends on the country circumstances. But for the ASEAN +3, where we have a mix of advanced economies and you have emerging economies, some of these structural reforms, you would say, would be expanding the workforce, addressing the tight labor markets. You have also to address better education for the young population, digitalization, and I think this is where the online NPL trading platform would really benefit if you have more of this digitalization efforts. So once we intensify some of these structural reforms, that will not just help monetary authorities to fight inflationary pressures, but you're also healing some of these pandemic scars. And I guess the second coming from Amro is that if we're talking about structural reforms, we cannot not talk about regional financial cooperation in this sense. And I guess IPAF is a good example of this. Online trading, this really requires a lot of regional collaboration and cooperation. Past crises has already highlighted it has been helpful in the recovery if you work together on mobilizing financial and technological resources to help each other. And I guess at the current situation, it really emphasizes the importance of having a fully operational regional financing arrangement. We can talk about swap agreements. Or some may say it's a bit hard now when countries are pressed for FX with the redemption pressures, but there's always, space to maybe we can think about ways to have more of these robust, versatile financing tools to basically strengthen the regional financing arrangement on top of the safety nets that we have. So I'll stop there.
Thank you. Wow, that's a really gigantic tasks. But Francisca, can you?
Yeah, thank you. I want to pick up on one thing Martha said about how the policy world has changed. It's really extraordinary how much policymaking has been improved since the 70s. That's why all these comparisons with the 70s are a bit fraught, because really central banks are a different place and economies are also a different place. There are now regional safety nets, like global safety nets, and central banks are just much better at doing their jobs than they've ever been in the 70s. So that's a piece of hope. Now, to come to your question about what should they do, what should be done, it's about, so I agree with Marta, these safety nets will be tested. So it's all about being ready for the safety nets to be tested. It's about getting these regional safety nets ready, but also getting what our colleague from Mongolia said, getting the national safety nets tested and national financial supervision tightened, the monitoring tightened, so you know where the vulnerabilities are. And when stress happens, there is a plan in place to resolve banks, to resolve corporates, to a backup plan, to get the backup plans ready now. Same for the fiscal side. For now, maybe fiscal pressures are not that high yet, but when stress comes, maybe there will be massive tightening needed. The deficits can no longer be financed. So it's a good time now to get ready for identifying the expenditures that will be cut when they have to be cut, and the kind of expenditures should never be cut. People should not go hungry. No? You don't want mass unemployment. So some expenditures just need to be preserved. So now is the time for all this contingency planning. And I couldn't agree more with the call for more structured supply side measures. Basically, keep these economies flexible. That's one of the advantages of having moved from the 70s. In the 70s, there was a lot of financial repression. Labor markets are very inflexible. Things have really changed. Economies were largely closed. Financial accounts were largely closed. The global economy looks completely different now. So it's on the right track for an open, rules-based global economy. That is the thing that is the foundation of growth.
Thank you. So, Arif, any thoughts?
Thanks. A lot have been said. I couldn't disagree with what has been suggested. But let me just also come to this point. There is no one-size-fits-all policy recommendations in facing uncertainty such as the one we face today. So at the end of the day, my recommendation would be based on specific issues that you guys are facing. So in this regard, I would strongly recommend going for a close monitoring of the situation going forward. You need to identify closely your asset compositions and the risks that are growing or faced by each asset items that you're managing. And as well, everyone always said, in every tough times, there are always opportunities. Identifying this point of opportunities within this very hard times is also going to be very important. And this can only be done by doing a close monitoring on the micro aspects of the assets that you are managing. Let me stop there.
Thank you. Very sensible. So, so do you have any specific, responses? Given that he already suggested country specifics, you have to actually, shape your responses to the country specifics.
I would say that there is one challenge which is very hard. Makes hard to recommend the kind of policy mixes that we still have growth. That is something which is confusing very confusing, I would say, because when we say that the situation is critical and policymakers should take I mean, should be very careful or something like that. What is the response? Is that we have growth this year, the world economy is growing, our economy is growing. What are you talking about? So this is something which is confusing. So it's not like we have a very clear-cut crisis or recession. It's not. It's not by any kind of statistics. But still, we know that there is inflationary problems, there are fiscal problems, debt problems. So I'm not sure how we can formalize it. Maybe we should take, I mean, every step and let's say address fiscal problems first, address monetary problems second, then address maybe NPL issues or government debt issues in a kind of not really kind of complex or systemized way, which is probably not the best way to approach the thing, but it's best what we can do as a policymakers, because we cannot say that we are in state of crisis. It's not like, for example, there is Asia crisis like in 1988. It's not. Any country is growing. So that, I think, is a major issue, and I would wholeheartedly agree with my colleague that we have to be country specific, of course, region specific. Europe probably has its own set of very, very different problems, and maybe they never had experienced, like for maybe even I would say 80 years or something. So in Asia we have growth, but we have also kind of old problems piling up together with this very, very slow growth, and maybe it will end in a very big collapse. I don't know, or maybe it will end in a kind of very nice break kind of out of the crisis and growth recovery. So let's do our job on every step, let's say, in our position, and then hope for the best.
Yeah. Well, everyone's hoping that Asia does avoid any crash. But I think also in Mongolia, there's some positives, right? Like coming from very high commodity prices, despite really like increasing uncertainties and then a lot of downside risks. Mongolia does have, in a way, some advantages of like a huge sort of like commodity exporters.
Yes.
I don't know how much of positives getting, because also like in some Central West countries, Central Asian countries that I heard, because of the war, there's also, getting, more flows because, it's a kind of like a trade, a diversion in a way from Russia.
Yes, I would say that I would be very, I mean, I don't want to say that we have some kind of positives from a war, because it's very hard to say. But the situation is like that, for example, because of that, because of this war, for example, a country like Mongolia, to some extent can benefit from commodity prices. And this is true. So this is something which we're experiencing. Secondly, something very, very interesting, and I never seen before, is that we have influx of refugees from mobilization, which means very healthy, strong men, like thousands of them come into our country. Usually refugees are kind of, family with kids or something like that. It's not like that. It's just perfectly healthy people, and they are willing to work in various fields. And that's what we are trying to accommodate. We're relaxing kind of labor market rules, visa rules, and from humanitarian point of view, yes, we don't want them to be, dying on the field, to be honest. Yes, it's better them to survive and not to become a killer or something like that. So that's our point. So we're accommodating thousands of these refugees. It does somehow, I think, contribute to the labor market. Maybe not now, but maybe in the longer term. We have to integrate those peoples in the society as well. So provide language training and something like that. Housing prices are rising, to be honest. We have to deal with that. And so this is something which is happening on that field. On the third, because of this crisis, the war crisis, logistics from Europe to Asia become very, very complicated. They cannot come by usual routes because they're all broken by this war, military operations. it comes like from the sea. I don't know, like, so it's very, very also interesting. And finally, I would say that because of that situation in our northern border, I mean, in Russian economy is changing day by day. And I would say it's very kind of collapsing, slowly collapsing. That's what I would say, because I don't have any internal data. But because of that, they're having this slow collapse. We are seeing increasing exports of goods to the Russian economy because they don't have any more these brands or something supply things. For example, like smartphones, I mean iPhones or Korean smartphones, whatever. So we are becoming kind of a hub for this trading. And even from the logistical point of view, when we flew here from Mongolia to Seoul and then to here to the Philippines, Manila, half of the seats were taken by the Russian travelers. So in a way, I think it's good for the air companies. We flew by Air Korea, but this is true, same for all these companies, I think, because they are selling more and more flight seats. And something which also I haven't experienced before, and this is not the usual refugees, they financially more, I think, better than usual refugees. So they have enough money to live whatever in hotels. not like a tourist. I even don't know how to explain it. But this is what we are seeing. Hopefully it will resolve in future.
Okay, well, thank you. Well, again, I think kind of really highlights the diversity across Asia. And as Arif already mentioned, in all challenges, there are opportunities. We just need to try identify those opportunities to still grow and still make that grow also sustainable and inclusive. With that, I would actually like to open the floor for any questions. Please identify yourself and then raise any questions you have. I suppose everyone's dying to just get lunch. Okay. So before lunch, there's one burning question.
Hello. Yeah, thank you very much for a great discussion and presentation. My name is Burkhard Heppe. I'm Chief Technology Officer of NPL Markets in London. I have a question about two aspects that I haven't heard much about on this panel, unemployment and house prices, because I think the question is this time different or is it not different? So this time is different. It's of course an important question. And in my view, two necessary ingredients to a financial crisis are missing this time, which is we have very tight labor markets and labor shortages. And when I look at the forecasts from the IMF and other institutions, there is no predicted increase or sharp increase in unemployment, as far as I can see. And the other is house prices. That's of course a bit more, say, sensitive. Very unexpectedly, house prices have risen dramatically during COVID, during a steep economic downturn. But now rising interest rates are probably cooling the housing markets. And I think The Economist was recently talking about a severe slump that might actually happen and has started to happen in some countries. So if you could comment please on the outlook of labor markets and house prices in light of financial crisis and rising non-performing loans.
Okay, so maybe I can ask two outlook people. Francisca?
Yeah, yes, so unemployment or the labor markets are still strong, and that is a difference to the 70s. In the 70s, the central banks always faced the trade-off. There was a lot of unemployment, but inflation was high. So that's one of the definitions of stagflation, the other one of the definitions of stagflation, not based on growth, but on labor markets. Now, this quandary is not something that most central banks face, because labor markets are strong and inflation is high. So in a way that argues just more for policy tightening. They don't need to hold back on the policy tightening, regardless of what happens to growth. So the strong labor markets may just be an invitation for getting closer to our recession scenario, because there's no unemployment to worry about. On the housing prices, at least for the US, there is now clear evidence that the housing market is cooling and cooling very rapidly. Now, some are still arguing that a lot has been learned in the 2009 crisis. Not a lot bigger buffers, debt is not as high, and household debt is also not as high. There's still excess savings from the pandemic checks that were sent out. So that should provide a buffer. The question is, how long can that buffer last? At what point is it going to erode away, and you really see the stress in household savings, household balance sheets, that then also reflects in consumption.
As we are exiting from actually like lockdowns, and I do feel that there's a increasing demand for labor, and that kind of like also suppresses I think the unemployment issues. But in the region especially, we've actually witnessed the quite rapid rises in household debt, especially some countries. I'm not going to name. So what do you see as a risk coming from the housing price cooling?
So cooling housing prices.
Household debt.
Household debts. Okay, so the housing prices in particular, I very much agree with Francesca before. In the US, we've started seeing the housing sector cooling down. And this is basically just attested to the idea that increasing interest rates will somewhat control the growing demand for housings in places. So as interest rate increase in the region as well, then the pressure for housing prices to increase will also be somewhat lessened. But in terms of increase in housing debt, this is something that for the region in particular, something that needs to be, that policymakers needs to put their attention to, because post the pandemic, even though labor market has somewhat improved, but the quality of employment is not the same. There are studies that starting to indicate that those who lost their jobs during crisis and get re-employed after the crisis tends to get less working hours and less income. So this is perhaps part of the reason why we are starting to look at increasing household debts these days. And given the situation where interest rates is going to be higher, then there is another possibility that this part of that component will add to non-performing loans in the coming future. So yeah, I guess that's another challenge for us to look at.
Thank you. We are actually running out of time, and then I would like to close the session. I would invite a round of applause to our excellent panelists today.